You've probably heard of the 2008 financial crisis. Maybe you remember the headlines, the stock market crash, the stories of people losing their homes. But what really happened? What was the real story behind the biggest economic collapse since the Great Depression? It wasn't just one bad day or one bad decision. It was a perfect storm brewing for years, built on a foundation of risky bets, deregulation, and a housing bubble that seemed like it would never pop. Let's start with something that sounds simple: the American dream of owning a home. In the early 2000s, this dream was more accessible than ever. Interest rates were incredibly low, making it cheap to borrow money. Banks were eager to lend, and they started offering something called subprime mortgages. These were loans given to people with low credit scores or unstable incomes, people who normally wouldn't qualify for a traditional mortgage. On the surface, it seemed like a good thing, helping more people become homeowners. But there was a catch. Many of these loans had low, attractive teaser rates that would skyrocket after a few years, making payments unaffordable for many borrowers. So why would banks take on such a huge risk? Because they weren't planning on holding on to these loans. This is where Wall Street comes in. Investment banks like Lehman Brothers, Bear Stearns, and Goldman Sachs bought up thousands of these risky subprime mortgages from the original lenders. They then bundled them together with other, safer mortgages, creating complex financial products called mortgage-backed securities, or MBS. The idea was to spread the risk. If a few people defaulted on their loans, it wouldn't be a big deal because the payments from all the other homeowners in the bundle would cover the losses. These mortgage-backed securities were then sliced up into different pieces, called tranches, and sold to investors all over the world: pension funds, insurance companies, even other countries. The top tranches were considered super safe, almost as safe as government bonds. And they received the highest credit ratings AAA from the major credit rating agencies like Moody's and Standard & Poor's. These agencies, who were paid by the very banks whose products they were rating, essentially gave a stamp of approval, signaling to the world that these investments were rock solid. Investors snapped them up, hungry for the higher returns they offered compared to safer, more traditional investments. The real genius, or perhaps the real madness, is a financial instrument called a collateralized debt obligation, or CDO. This is where it gets complicated, but stick with me. Investment banks took the riskiest, lowest-rated pieces of those mortgage-backed securities, the ones that were most likely to fail, and bundled them together again. They then sliced up this new bundle and, believe it or not, managed to get the top slices rated AAA again. It was financial alchemy. They were taking junk, repackaging it, and selling it as gold. The system was creating a huge, invisible mountain of risk. But because everything was rated AAA, almost no one seemed to notice or care. The money was flowing, and everyone was getting rich. But the whole system was built on one crucial assumption: that house prices would always go up. As long as home values were rising, homeowners who couldn't afford their mortgage payments could simply sell their house for a profit, pay off the loan, and everyone would be fine. But what happens when the music stops? What happens when house prices stop rising and start to fall? By 2006, the cracks began to show. The low teaser rates on all those subprime mortgages started to reset to much higher rates. Suddenly, millions of homeowners saw their monthly payments jump, sometimes doubling or even tripling. At the same time, the housing market, which had been on a historic run, began to cool off. With so many new homes being built and so many people trying to sell, supply outstripped demand. House prices stalled, and then they started to drop. Now, homeowners in trouble couldn't sell their homes for a profit to escape their unaffordable loans. They were trapped. Many were underwater, meaning they owed more on their mortgage than their house was actually worth. Foreclosures began to skyrocket. People were losing their homes at an unprecedented rate. This was the first domino. When homeowners defaulted, the mortgage-backed securities and CDOs that were built on their payments started to lose value. The safe AAA investments were suddenly not so safe. Investors who owned these products started losing billions of dollars. Panic set in. No one knew who was holding the toxic debt. No one knew which banks were on the verge of collapse. The trust that holds the entire financial system together evaporated overnight. Banks stopped lending to each other. Credit markets froze. This is the lifeblood of the economy. When credit freezes, businesses can't get loans to operate. They can't make payroll, and they start laying people off. The problem that started in the U.S. housing market had now gone global, infecting the entire world's financial system like a virus. The first major casualty was Bear Stearns, a major investment bank, which nearly collapsed in March 2008 before being bought out by JP Morgan Chase in a fire sale brokered by the U.S. government. This was a massive warning sign, but the worst was yet to come. In September 2008, the system reached its breaking point. On Monday, September 15th, Lehman Brothers, a 158-year-old titan of Wall Street, declared bankruptcy. The government had decided not to bail them out, hoping to send a message that no firm was too big to fail. But the shockwave from Lehman's collapse was catastrophic. It triggered a complete meltdown. Stock market plummeted. AIG, the world's largest insurance company, was on the brink of failure because it had insured tens of billions of dollars worth of these toxic CDOs. A failure at AIG would have brought down the entire global financial system. To prevent that, the U.S. government was forced to step in with a colossal $85 billion bailout. The crisis was no longer just on Wall Street. It was on Main Street. The global economy plunged into a deep recession. Millions of people around the world lost their jobs, their savings, and their homes. It took years of government bailouts, stimulus packages, and new regulations like the Dodd-Frank Act to stabilize the system and begin the slow, painful process of recovery. So, who was to blame? Was it the greedy bankers on Wall Street creating risky products? Was it the rating agencies that gave them a stamp of approval? Was it the government regulators who looked the other way? Was it the lenders who gave out bad loans? Or the borrowers who took on debt they couldn't afford? The real story is that it was all of them. It was a systemic failure, a chain of irresponsibility from the top to the bottom. The 2008 financial crisis serves as a powerful reminder of how interconnected our global economy is, how quickly greed and a lack of oversight can lead to disaster. The story isn't just about numbers and complex financial terms. It's about the real-world consequences that affect us all. Understanding what really happened is the first step in making sure it never happens again. Thanks for watching. If you found this deep dive interesting, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next video. Let us know in the comments what other major events you'd like us to break down. See you next time.